For 12 years, my life was completely backwards. I clocked in at 6:30 p.m. and escaped at 7 in the morning, trading my health on the graveyard shift for a predictable paycheck. When I finally quit, the index fund purists in my comment section started chanting that I would go completely broke. Today, we're going to strip away all the advisor hype. To survive right now, my family needs 6,014 Canadian dollars each and every month. Line by line, we've got the mortgage, truck, groceries, bills, but I already made a video about all that. You can check it out up here. In this video, we're going to run a hypothetical experiment using 5 different Canadian portfolio scenarios to see exactly how much cash I have to invest to hit that monthly mark. And to my American audience out there, stick around until the end because I'm going to share the exact US equivalent funds you can use to build this exact same system. So let's head back to the office and open up the ledger. If you throw your money into a basic index fund paying a tiny dividend yield, you're going to be waiting a lifetime to build enough capital to do this. We don't have time to wait around. So let's look at what happens when we manipulate yield across 5 distinct allocations to hunt down our target of $6,014 a month. This channel isn't about growth investing. I know that if you go with a growth fund, the plan would be to sell a small percentage every year to live off. That wouldn't work to build my bridge away from the graveyard shift, so we're looking at dividends and distributions. First up, we look at scenario 1. Which is our hyper yield model built using TSLY and NVDY. This grounds exactly why my current personal portfolio has leaned heavily in these spaces. I'm going to use Dividend Watch to run these numbers. I'll have a link to the calculator down in the description, but no, they aren't a sponsor. Okay, so first we need to calculate how many shares we'll actually need to own to reach our $6,014 a month target. Since yield is always listed on an annual basis, the first step will be to get our annual target. So to get our annual, we know we need 6,014 per month. We just multiply that by 12, and we get our annual target of 72,168. Now let's load up our dividend.watch calculator and plug in TSLY and NVDY with just a single share each to get our baseline annual income. So I'll walk through this first portfolio and using dividend.watch, and with the rest, I have screenshots that I'll share. So we'll first search here for TSLY, and we want the yield max one in this case. So we'll add that with 1 share. And then we'll also search for NVDY, again, the yield max one on the New York Stock Exchange, 1 share each. Okay, so now if we come down here, we have to calculate first. Actually, we should check out the options before we go anywhere. For price growth, I'm going to say 0. We could always use custom and put in negative for this one, but I want to just look at what's happening right now. In our case, we're not going to be adding any investments per month, but you could always adjust this for yourself. I've already set my currency to be in Canadian dollars. We are going to throw in 15% income tax on this one. That's to account for the withholding tax that I have coming from a US-based fund in these cases. I don't have any other taxes on these because I hold them in my TFSA. We'll go for 15 years and leave DRIP off because I need to be withdrawing from it. And I got to hit it again, and there we go. So we get a annual dividend to start of $23.51, and that is with 1 single share. So now we want to find out how many shares we would need to reach our annual target. So we'll divide this annual target by 2351. I have a feeling you can't see this, so I'll just throw up a screenshot here afterwards. We're going to need 3,000, and we'll call it 70 shares. total, we need the full amount each, so 3,070. There we go. We get our 72,000. And what we want to really look at now is if we scroll down on Dividend Watch, we can see our portfolio value. So this is how much we'll have invested. Of course, we could just add these costs together, but I like coming down here and looking at the portfolio value. And this chart would change if we had set a growth estimate, but because we haven't, it just stays right here, telling us that we would need to invest $175,268 into TSLY and NVDY, combined, not into each, but a combined portfolio of $175,000. That's not that bad. That's doable. And that's why these funds are so tempting. It's why I started investing in them as early as I did, and this chart as well, with the annual dividend income going up because the yield does increase. It's expected to increase. I didn't set it to, but it's the NVDY has 100% yield growth, not price growth, but yield growth. That's wild. We're not going to trust that by any means. In fact, we won't even trust it to stay where it is. I fully expect it to continue to go down as I have seen. So when you're using something like Dividend Watch, don't take their built-in metrics as gold. They're predictive, and of course, past performance is not indicative of future performance. So keep that in mind as you're building things out. But I wanted to show as a base how low of a portfolio, not that $175 is low, not that people have that hanging around. I certainly don't. But compared to what we're about to see, that's a very small portfolio amount to get us to our goal of meeting my family's needs. Now let's swing to the complete opposite end of the spectrum with our second scenario. Here, we're going to look at a highly respected dividend aristocrat that's been actively increasing its distributions for years. TELUS, or stock ticker T on the TSX. And you can choose anything you want. That's the great thing about using Dividend.watch. Again, they're not a sponsor, but you can plug in anything you want, and if they have a similar yield to what I'm discussing, your results will be very similar. Dividend purists often recommend going with an aristocrat because they've had dividend growth over time and often some share price growth as well. But my problem is I don't have the capital available to get what I need out of something like this. As you can see, to get enough distribution to cover my family's needs from a stock like TELUS, I would need to invest over $750,000. I don't have that. Now, if I had a rich uncle that had kicked the bucket and I was sitting on a stack like Warren Buffett, that's certainly a viable option. But for the average working person, especially one trying to escape a soul-crushing job, that timeline just won't work out. So let's move on to a third portfolio scenario. This one is essentially what I'm building towards as my level 1.1 and level 1.2 of the game. HHIS and BIGY. Maybe subbing BIGY for EAS. But Dividend.watch didn't have easy available yet. So we'll use the same calculations we used back when we set up the YieldMax portfolio here. And with that all set up, we would need 8,541 shares of both HHIS and BIGY to meet our monthly income target. That means we'd need to invest almost $258,000. That's a lot more achievable than $750,000 that we would need if we were to go with our TELUS portfolio. But many commenters feel HHIS and BIGY are still too risky. For investors who want lower volatility and a safer baseline, you might want to look at our scenario number 4. This model utilizes diversified income wrappers, HYLD, BANK, HDIF, and EIT.UN. These funds require a much larger capital base because their yields sit in a safer, more stable band, averaging around 10%. You'll need to pull together a total of $642,000 across these 4 assets to clear our monthly $6,014 hurdle. It'll take more grind to build, but it might let you sleep a little sounder through market storms. Finally, we reach scenario number 5. This layout combines our 3rd and 4th scenarios into one combo. It takes the lower yield stable wrappers from scenario 4 and adds back in our higher voltage power of HHIS and BIGY. By distributing the load evenly across all 6 vehicles, our total capital hurdle drops to a more achievable $416,000. Now, don't get me wrong, that's still a big target to hit, and I'm certainly nowhere near it, but it's a target nonetheless. I'm calling this one out right now because this is the actual blueprint that I'm personally building towards in real time. It balances the immediate income I need with broad sector preservation. I'm starting with the higher yield HHIS and BIGY funds, and then once I achieve a target there, I'll be moving on to these lower ones. Well, let's break down the mechanics of how these structures actually work under the hood. The comment section trolls think these distributions are a trick because they don't understand how options execution works. The hyper-yield option plays like TSLY are just portable generators. They write aggressive covered calls on hyper-volatile single stocks. They burn through structural fuel fast. They'll drop your principal when the underlying asset tanks. But they blast out massive immediate cash that can patch a hole in your budget. The thing is, you can't run your entire house on a portable gas generator forever. You need to build a permanent power grid. And that's where the assets like HYLD, BANK, and HDIF come in. They package broad sectors, apply modest leverage alongside structured cover call writing to shield your core net asset value while feeding you a consistent, dependable distribution. You can use the generator to survive the transition, but you accumulate the permanent power grid to secure long-term freedom. But let's be radically honest here. You can't fund a massive passive dividend machine if you don't have strong active income to start with. Unless, of course, you're sitting on that aforementioned stack like Warren Buffett. Right now, my own investment portfolio acts as a critical bridge to fill the $1,500 monthly salary shortfall from my business. That's a tactical defensive position, not an offensive victory. To eliminate that shortfall permanently, I'm out executing every single day to scale my business, Why Not Tech Services, to a non-negotiable revenue target of $200,000 in annual revenue. My mission is direct. I build total data security infrastructure to protect senior citizens from the gutless tech scammers trying to clear out their retirement accounts. And I run the entire operation on a strict profit-first methodology. I don't use active income revenue to buy personal comforts. I use it to buy more shares of the grid. If you want to find out how to lock down your parents' hardware, or want direct access to my Digital Independence AI Masterclass, check out the pinned link below. I scale the active engine, protect my community, and I feed the portfolio all through my active income. I'm on a relentless mission to lock down $3,500 every month from the more permanent Scenario 5 portfolio. This mission is anchored by my immediate quest to hit $1,000 a month from HHIS alone. Now, for my American audience, I told you I wouldn't leave you hanging, so if you're looking to build a similar cash flow strategy south of the border, the math behaves the exact same way. Your high voltage version of Scenario 1 is exactly the same because I actually used US-based funds for that. Scenario 2 could be built using US dividend aristocrats or kings like Coca-Cola. And moving into Scenarios 3 and 4, you'd probably be looking at tickers like JEPI, JEPQ, or SVOL. The currency symbols might change, but the rules of discipline remain the same. Stop checking your daily price charts, calculate the real cost of your existence, and track your cash flow velocity. Make sure to keep your active cash coming in. And drop a comment below with your exact monthly dividend income target right now. I don't care if the number is $10 or $10,000. Put it in stone, and let's see who's actually executing. Hey, subscribe, hit the bell, and keep going. I'll see you in the next one.